What if one banking rule changed the safety of your savings overnight? Across the UK, new cash limits and deposit protection laws are reshaping how secure your money really is. Most people believe their funds are fully safe in the bank, but the truth is far more complex. From hidden group licenses to new thresholds set for 2025, millions could be unknowingly exposed. As the government adjusts protection levels and banks tighten cash policies, knowing where your money sits has never mattered more. This isn't fear, it's awareness, because in 2025, financial safety comes with new rules.
Number 1. Know your protection limit. Most UK bank customers are covered under the Financial Services Compensation Scheme, or FCSC, which protects your money if a bank fails. The current limit is £85,000 per person per authorised institution, but regulators have announced plans to raise it to £110,000 from December 2025 to reflect inflation and preserve real value. This means if your bank collapses, the FCSC will refund you up to that amount automatically within 7 days. The key is that the limit applies to each licensed bank or building society separately, not each brand name you see on the high street. Some banks operate multiple brands under one license, so combining deposits under those brands may not increase your protection. For example, Halifax and Bank of Scotland share the same license, so money held in both would count as one pot for the £85,000 limit. If you have more than the threshold in a single banking group, you risk losing any amount above that limit if the bank fails. The FCSC protects individual and joint accounts separately. A joint account offers up to £170,000 of coverage because each holder is protected for £85,000. Always check the authorised institution name listed on the Financial Conduct Authority register to know how your bank is licensed. The proposed increase to £110,000 follows a Bank of England consultation that aims to update safeguards every 5 years. Rising living costs and high inflation since 2017 have eroded the value of the current limit, so the new threshold will better match average UK deposits. Keeping your balances within the limit is a core rule of financial safety. If you hold larger amounts, spread them across different banks that have separate licenses. Knowing these limits helps you protect your savings without needing complex investments or extra fees. Awareness equals protection.
Number 2. Understand per institution and banking groups. Many UK savers mistakenly assume that using different brand names automatically means separate protection. The truth is that FSCS coverage applies per authorised institution, not per brand. This means that if several banks share a single regulatory license under one parent company, your total eligible deposits across those brands count as one combined balance. For example, Halifax, Lloyds Bank and Bank of Scotland all operate under Lloyds Banking Group, so holding £85,000 in each does not triple your protection. The total protected amount remains £85,000. This rule also applies to building societies and online banks, which may share back-end licenses you might not easily recognise. To verify whether two banks share the same license, always check the Financial Conduct Authority (FCA) or Prudential Regulation Authority (PRA) register. Each authorised institution is listed with its unique firm reference number and covered brands. The FSCS website also provides an updated list showing which banks fall under the same umbrella. Understanding this grouping is vital for anyone with large or multiple deposits, especially high net worth individuals or small business owners using different brands within one group. Without checking, a person could unknowingly exceed the limit and risk uncovered losses in the event of failure. The safest approach is to spread deposits across banks that hold separate authorizations, ensuring that each account benefits from its own £85,000 or £110,000 after 2025 protection cap. This diversification reduces concentration risk and helps maintain full coverage for your savings portfolio. It's also smart to review any recent mergers or acquisitions, as these can alter group structures and change which licenses apply. By regularly monitoring your banking relationships and verifying institutions, you can safeguard your funds effectively and avoid unpleasant surprises if market turbulence ever hits the UK financial system.
Number 3. Note the temporary high balances exception. Sometimes life events cause a sudden rise in your bank balance, selling a home, receiving an inheritance, or getting redundancy pay. For those moments, the Financial Services Compensation Scheme, FSCS, provides temporary high balance THB protection, offering extra coverage beyond the normal £85,000 limit. This rule recognizes that people may hold large sums before moving or reinvesting them. Under the latest Bank of England consultation, this cap will increase from £1 million to £1.4 million starting December 2025, reflecting rising property values and inflation. The protection lasts for up to 6 months from the date the funds are credited, giving you time to transfer or distribute your money safely. This rule is particularly relevant for homeowners, business sellers, or anyone expecting a lump sum payment. For example, if you sell a property for £500,000 and deposit it in a single bank, you're covered under THB rules for 6 months, even though it exceeds the normal FSCS limit. However, it's important to keep records, such as sale contracts or legal statements, to prove the origin of the funds if the bank fails during that period. The FSCS requires clear evidence that the balance resulted from a qualifying life event. After 6 months, standard limits reapply automatically, and anything above £85,000 or £110,000, once increased, would again be unprotected. To maximize safety, plan transfers early and avoid keeping excess amounts idle beyond 6 months. Spreading funds across different licensed institutions before the THB window closes ensures continued coverage. Many people forget that this temporary rule exists, yet it can protect large windfalls that would otherwise sit exposed. Understanding and using the THB provision strategically transforms a short-term vulnerability into a structured safeguard for your most valuable transactions.
Number 4. Be aware of cash deposit limits at bank branches. In recent years, several UK banks have tightened their cash deposit policies to comply with stricter anti-money laundering regulations and reduce financial crime. Many institutions now impose limits on how much cash individuals can deposit into personal accounts each year or per transaction. Some high street banks cap deposits at around £20,000 annually, while others apply daily or monthly thresholds depending on account type and risk profile. These limits apply not only to cash deposits made in branches, but also to those processed through cash machines and post office counters. The purpose is to track unusual patterns and ensure that all funds entering the system have a verifiable source. For everyday customers, these policies mean that large cash-based businesses or private sellers may encounter delays or rejections when attempting to deposit higher sums. A bank can legally question or even block a transaction if it cannot confirm the cash's origin. You may be asked to provide proof of source, such as invoices, sale receipts, or wage slips. Depositing large amounts repeatedly without documentation can trigger account reviews or temporary freezes. As more people use digital payments, cash handling is viewed as higher risk, prompting banks to adopt these preventative measures. The Financial Conduct Authority, FCA, supports this shift as part of the UK's broader AML compliance strategy. To stay within safe limits, always confirm your bank's deposit policies before handling large cash amounts. If you operate a cash-intensive business, consider using business banking services that allow larger deposits with proper documentation. Also, explore electronic payment options to minimize physical cash risks. Understanding these restrictions ensures smoother transactions, protects your account reputation, and helps you maintain compliance with the latest UK financial regulations while keeping your funds accessible when you need them most. Number 5. Consider the risk of large deposits exceeding protection. When keeping money in the bank, safety doesn't mean unlimited protection. The Financial Services Compensation Scheme, FSCS, covers up to £85,000 per person per authorised institution, and the limit will rise to £110,000 from December 2025. Any balance above that threshold is uninsured in the event of a bank collapse. While UK bank failures are rare, the financial landscape can shift unexpectedly. If your account balance exceeds this limit, the uncovered portion could be at risk during insolvency, leaving you waiting for a partial recovery after liquidation. This makes it vital to review your total deposits regularly, especially during times of economic uncertainty or banking sector stress. The simplest way to mitigate this risk is diversification. Spread funds across multiple institutions with separate regulatory licenses rather than relying on a single bank. Joint accounts can increase coverage because each holder receives their own FSCS allowance, effectively doubling protection to £170,000 under the current rules. High net worth individuals, landlords, or small business owners should map out their cash positions across all accounts and compare them with FSCS authorized entities. The FSCS and Financial Conduct Authority websites both provide search tools that confirm which brands share a single license. Regularly checking this list helps prevent accidental overexposure. Remember that even with rising protection limits, inflation and evolving financial risks mean full safety requires strategy, not just regulation. Keep a clear balance sheet, monitor how much sits idle in current or savings accounts, and consider using money market funds or premium bonds for amounts beyond insured limits. These options still offer liquidity while lowering exposure to institutional failure. Financial security is not just about saving, it's about structuring where you save. Awareness of these thresholds transforms passive banking into active financial protection.
Number 6. Smaller banks, building societies, and credit unions also qualify. One of the biggest misconceptions among UK savers is that protection only applies to big banks. In reality, the FSCS coverage extends to all UK authorised institutions, including smaller banks, building societies, and credit unions. This means your savings in a small regional bank or a local credit union are equally protected up to £85,000 per person, or £110,000 after December 2025. The Financial Conduct Authority, FCA, and Prudential Regulation Authority, PRA, strictly regulate these institutions to maintain capital adequacy and ensure depositor safety. While smaller banks may not have the global presence of major players, they must still meet the same standards for risk management, liquidity, and customer protection. However, smaller firms can face unique challenges during economic stress, such as liquidity shortages or limited access to emergency funding. That's why verifying the authorized status of your institution is essential before depositing large amounts. You can easily confirm this on the FCA register or the FSCS website, which lists all covered entities. If a small bank or credit union ever fails, the FSCS automatically steps in and repays eligible depositors within 7 days, the same speed and reliability offered to customers of larger banks. The system does not discriminate by size. It only requires that the institution be properly authorized. Smaller institutions can even offer competitive interest rates or community-based benefits, making them attractive options for diversifying savings. By spreading funds across a mix of large and small regulated institutions, you can enjoy higher returns without sacrificing safety. The key takeaway is that banking security in the UK depends on regulatory authorization, not brand size or popularity. Understanding this levels the playing field and helps savers confidently explore a broader range of financial options while staying fully protected.
Number 7. Stay alert to changes in the regulatory environment. The UK banking system constantly evolves to adapt to economic pressures, inflation, and digital transformation. Regulators like the Prudential Regulation Authority, PRA, and the Financial Conduct Authority, FCA, frequently update deposit protection and cash handling rules to ensure stability. The upcoming increase of the FSCS limit from £85,000 to £110,000 in December 2025 reflects these changes, designed to maintain depositor confidence and account for inflation since 2017.
Alongside this, the PRA is also modernizing reporting systems to allow faster payouts and better oversight in case a bank fails. For savers, this means that the safety net is improving, but awareness of these developments remains crucial to avoid outdated assumptions. In addition to deposit protection, other financial regulations have tightened in recent years. The FCA's anti-money laundering guidance has led banks to monitor cash deposits more closely, enforce stricter identification checks, and sometimes set transaction limits. The Bank of England is also exploring new digital frameworks, such as a potential digital pound, which could eventually change how deposits are managed or guaranteed. These ongoing updates demonstrate that financial security isn't static. It's a dynamic system that responds to market shifts and global risks. Keeping track of official announcements helps ensure you're aligned with the most current protection standards. To stay informed, visit the FSCS, FCA, and Bank of England websites periodically or subscribe to their update newsletters. Major news outlets like the Financial Times and BBC Business also report policy changes affecting deposit safety. Even small regulatory adjustments, such as a new cash deposit limit or an interest rate policy shift, can influence where and how your savings are safest in an ever-changing UK banking landscape.
Number 8. Don't treat deposits as investment returns. Inflation still matters. Even though bank deposits are considered safe, they are not immune to the silent erosion caused by inflation. The FSCS guarantees the security of your funds up to the current limit, but it does not preserve their purchasing power. As prices rise, the real value of your savings decreases, meaning that £10,000 today may buy less in a few years. This is one of the main reasons the Bank of England proposed increasing the deposit protection limit from £85,000 to £110,000 by the end of 2025. The goal is to maintain parity with real-world economic conditions, acknowledging that the cost of living and average deposit sizes have grown significantly since 2017. Leaving large sums in low-interest current or savings accounts might feel secure, but the return often lags far behind inflation rates. When inflation runs above the bank's offered interest, your savings effectively lose value each year. For example, if inflation stands at 4% and your savings account yields 2%, your real return is negative 2%. To manage this risk, it's wise to diversify some funds into inflation-resistant assets, such as premium bonds, index-linked savings certificates, or short-term investment products with low volatility. These tools help protect the real worth of your money without exposing it to excessive risk. However, maintaining a cash buffer remains essential for emergencies and short-term needs. A balanced strategy involves keeping a portion of your funds easily accessible while allowing another portion to grow in line with or above inflation. Understanding the difference between nominal safety and real value is crucial for long-term financial health. Deposits protect capital from loss, but smart allocation protects your purchasing power, and that is the real measure of financial security in today's economy. Number 9. Understand that safety covers bank failure, not every risk. Many people assume that once their money is in a regulated UK bank, it is protected from every kind of risk. In reality, the FSCS only covers your deposits if the bank itself fails financially. It does not protect you from losses caused by inflation, interest rate drops, currency devaluation, or personal misuse of funds. The scheme guarantees repayment of up to £85,000 per authorised institution, increasing to £110,000 in December 2025. But that safety applies solely to insolvency scenarios. Other risks, such as digital fraud, cyber attacks, or card theft, are managed through your bank's security measures and not the FSCS itself. Understanding this distinction helps you see that safe doesn't always mean risk-free. Operational issues like delayed transactions, online banking outages, or branch closures also fall outside the FSCS remit. If a payment is temporarily stuck or a transfer is reversed, you must resolve it directly with your bank rather than relying on depositor protection. Similarly, while deposits are guaranteed, Any linked investment accounts, such as ISAs or market-linked products, may carry different rules and separate compensation limits. Knowing what's covered and what isn't prevents confusion during a financial emergency. Always read your bank's protection disclosures carefully, as these clarify what category each product falls under. To reduce exposure, maintain multi-channel awareness, enable security alerts, keep two-factor authentication active, and monitor statements frequently. Cybercrime and identity theft have risen sharply, making personal vigilance as important as institutional protection. The FSCS provides a strong foundation for deposit safety, but only when paired with responsible banking habits and digital awareness. By distinguishing between guaranteed safety and practical risk management, you ensure that your savings remain both secure and accessible in the real world of modern banking.
Number 10. Use this as a trigger to review your banking strategy. With new UK cash limits and upcoming deposit protection changes, now is the perfect time to reassess your overall banking strategy. Financial safety is not just about keeping money in one trusted place, it's about understanding how to balance protection, accessibility, and growth. Start by reviewing how much you hold in each bank and whether those institutions share the same regulatory license. The FSCS limit, rising from £85,000 to £110,000 in December 2025, applies per authorised institution, not per account or brand. If your balances exceed that limit in one place, it's time to diversify across separate banks or building societies to maximise coverage. This approach prevents overexposure and ensures that every pound remains within a guaranteed safety net. A practical strategy involves creating a banking map, a simple table showing each institution, license holder, account type, and balance. This makes it easy to identify where funds should be shifted for optimal protection. Don't forget to include joint accounts, which receive double coverage because each holder is insured separately. Also, review accounts connected to businesses, charities, or property transactions, as some may qualify for temporary high balance protection up to £1.4 million for 6 months. Having this overview helps you stay proactive rather than reactive when financial uncertainty strikes. Finally, reassess your liquidity needs and long-term goals. Keep enough in instant access accounts for emergencies, but explore inflation-resistant savings or low-risk investments for surplus funds. Schedule an annual or semi-annual review of your protection limits and banking relationships. If regulations, interest rates, or personal circumstances change, adjust your allocations accordingly. A structured and informed strategy keeps your money both safe and productive, turning static savings into a well-protected financial system built to thrive under evolving UK banking rules.
The new UK cash limits and updated FSCS deposit protection rules mark a major shift in how people should manage their savings. With the protection cap rising from £85,000 to £110,000 in December 2025 and temporary high balances increasing to £1.4 million, this is the right time to rethink how and where you hold your money. These changes are designed to strengthen financial stability and reflect inflation, but they also remind everyone that banking safety depends on awareness. Knowing which institutions share licenses, understanding deposit limits, and keeping proof for large transactions are not just formalities, they are essential safeguards. Financial protection isn't about fear, it's about smart structure. Spread your funds across authorized institutions, monitor your balances, and stay informed about ongoing policy updates from the Bank of England, FCA, and FSCS. Safe money is planned money, and in the modern economy, security belongs to those who pay attention. If you found this video helpful, like, subscribe, and share it with anyone managing savings in the UK. Comment below where you're keeping your deposits and how you're preparing for the 2025 banking rule changes. Stay informed, stay protected, and keep your money working safely for you.